Hi everyone, my name is Victor Colella, and I'm a financial planner with our planning team here at Advisor Investments. Today, I'm joined by my colleague, Rick Winters. Rick is Vice President and Advisor. You've heard him on another podcast before, I think, and he works with individuals and institutions to help them reach their financial goals. So he's a relationship manager here. He's a certified financial planner, and he's earned other designations like the CRPC, the AWMA, you name the alphabet soup, he may have it.
Keep him busy over here.
That's a fancy way that he likes to learn. So now that I've inflated his ego, let's introduce the topic. So today we're going to talk about the 7 habits of highly effective investors. And this is 7 steps that you can take now, as it's the end of the year, to reduce your tax bill this April. So, for me, one of my favorite books is The 7 Habits of Highly Effective People. And whenever I hear there's a list of 7 actionable steps, I tend to pay attention. So hopefully it has the same effect. So I'm not going to waste any time. I'm going to jump right in. Our first step is take a look at rebalancing. So Rick, why is rebalancing important to you? Why do you talk about it with our clients?
Think about where you get started when it comes to investing. You got to come up with a plan. You got to figure out what you're trying to accomplish, what you're willing to tolerate. And one of the things that has to happen is ongoing. You spend all this time up front trying to figure out how to build this portfolio, and then the stock market goes and moves around. Sometimes it's up, sometimes it's down. And as you move along, well, maybe that nice 60-40 allocation that you had to get started is now 65% stock, 35% bonds. And you start thinking, maybe I should rebalance that. Now, conventional wisdom would say January rolls around, rebalance. Get that back to its original target allocation. Well, here at Advisor Investments, we would take a slightly wider view and say, no, maybe there's other ways that portfolio can rebalance itself. Let some of those winners run. Don't take a hard and fast like January rebalance. Rebalance as your portfolio lives.
Yeah, so this step, I'm not saying systematically rebalance right now. It's really just to take a look. It may or may not make sense to take action. It could either help or hurt you if you rebalance depending upon your situation.
That's absolutely right. I mean, rebalancing by a set rule could get kind of expensive. What are you doing when you're selling something that's winning? You're selling gains. When you're selling gains, you got to pay taxes. So maybe there's some other things going on, like distributions from the funds, or maybe you take a cash flow to pay your bills that you can use as a way to rebalance that portfolio.
Sure. Now, you said distribution, so I'm going to jump to the second item. So the second one is, what's a distribution calendar, and what do we need to know about it? So we talk a lot about mutual funds. We invest in mutual funds. Talk a little bit more about this one.
Yeah, so we put our heads in the proper place. Let's know that we're talking about taxable accounts right now. I mean, in an IRA, it doesn't matter. If distributions are paid out, you don't owe capital gains or taxes or anything like that. But in a taxable account, these distributions are made up of interest, dividends, capital gains. What do you do with those things? You pay taxes on them. So you got to be very aware of these distributions that are coming out of these funds. You don't want to, distributions are paid out throughout the year. Distributions mainly on mutual funds come in November and December where they're the largest. So if you're sitting on a pile of cash in October and go and flood it into your portfolio, you may find yourself paying some unwanted taxes. So you got to be really careful. That's a word of caution. But distributions are inevitable when you're dealing with mutual funds.
Yeah, and what we typically do, because we work with mutual funds on a regular basis, we create a calendar in October, specifically identifying, which dates for which funds you should perhaps buy an alternative. Instead of buying the distribution, you buy an alternative fund, so you don't actually buy a tax bill.
That's our gatekeeper. That's not going to allow someone to just come in and put a trade in and wind up buying a distribution you didn't know you were going to buy.
Yeah, fair enough. So let's say that you have a gain from a distribution, perhaps. That takes us to number 3. So tax loss harvesting is something we talk about on a regular basis, and it's what we think is the third habit that you should make towards the end of the year, is take a look at tax loss harvesting opportunities. So unpack that for me, right?
Yeah, let's state it plain and simple. Get this point across. Losses have economic value, and I'll explain what I mean by that. So let's say I made a good investment, and I'm looking at a gain here. I bought something for $100,000. I know that's a big number, but let's say I bought something for $100,000. It's grown to $110,000, and I sell it. What happened? I just realized a $10,000 gain. That's great. I did a good job.
So you may only get $7,000 or $8,000 of that.
Yeah, think about it. I mean,
yeah.
So if my tax rate is anywhere from, on that gain, 0 to 30+%, depending on whether it's long or short term, that's a pretty big impact. So what do I talk about with losses? Well, if I've got another position at some point throughout the year because the market's bouncing all over the place,
Sounds familiar.
Sounds familiar. It happens from time to time. And now you've got a position that you bought for 100, and now it's trading at 90. Well, I can sell that and realize that loss, and I can use that $10,000 loss to offset that gain.
And maybe you don't have a full $10,000 gain to offset it with. You can carry those losses forward, which is something important to note.
And I didn't just throw in the towel, man. I took that $90,000 and I turned around and bought something else. Maybe something comparable to the investment I just sold, or something completely different. But I'm now back in the game. And if I grow that 90 to 100, I'm back to whole. I've got my gain. I didn't pay any taxes, and I'm home free.
Yeah, makes a lot of sense. All right, so that's number 3, so tax loss harvesting. Number 4 is, are your accounts set to automatically reinvest? Maybe take a look at whether that automatic reinvestment should be turned off for the year.
Yeah. Let's keep this one simple. For IRAs, not an issue. Why? Because you're going to be able to have that money automatically reinvest. There's no taxes. And assuming you invest like us, there's no transaction expenses. So have that money reinvest. But when it comes to a taxable account, I would take our advice and have it paid to the money market. Why? Because you're going to be paying capital gains tax or interest on the dividends or taxes on the interest. And you may want to use that money. Maybe you got to buy a car that year, or just pay the grocery bill and you just need cash. So, or maybe you want to rebalance the portfolio. That cash would be available to do that.
Yeah, or to tie it all back together, number 2 is pay attention to the distribution calendar. Maybe you're automatically reinvesting into a distribution and you're buying yourself a tax bill.
That would be sad.
Which is never ideal, right?
That's right. You don't want to have that automatic reinvestment pop back in there for a big distribution. Something that would not be good.
Yeah. So those first 4 really all do work together. So paying attention to opportunities to rebalance, the distribution calendar. I mean, you're talking about gains and losses, so loss harvesting factors in there.
Yep.
And automatic reinvestment just gives you the ability to be flexible.
That's right.
So now number 5 is, can you maximize your deferred growth vehicles? So are there opportunities to maximize these? What am I talking about here, Rick?
Yeah, so here what we're talking about is 401ks, IRAs, simple IRAs, and SEPs. I mean, there's more beyond that. But what we're talking about here is being able to get as much money as you can into a deferred position so it can grow over time, not have to pay taxes now as you make the contribution. Each have their own limits. And one thing we like to highlight with our key financial data update that we send out each year is to make sure that you have those limits at your hands and at your fingertips. My world's greatest cheat sheet, as I describe it.
Well, and I'd be remiss not to mention here as well, not just tax-deferred vehicles, but some tax-free savings vehicles. So you may know I'm talking about Roth IRAs, sometimes Roth 401ks, and also, my personal favorite, there's a prior podcast on this, health savings accounts, or HSAs.
Very smart. Don't miss them. I mean, because the limits, if you don't hit them at the right time, obviously you've got your year-end limits for, getting it down December 31st for your 401k, but you may have as late as your tax filing on some of these others.
Yeah, that's a big one to highlight. So those employer-sponsored plans are typically, you do have end of the year as your deadline to get those contributions in. But for a lot of those other accounts, the IRAs, the Roth IRAs, the HSAs, you actually typically have till April tax deadline. So
and for the self-employed ones, you have all the way until October 15th.
Yeah, that's a good point. All right, I'm going to move on to number 6. So number 6 is don't miss your RMD, or required minimum distribution. This one's pretty easy, but Rick, tell us a little bit about what they are, why you shouldn't miss them, I guess.
Well, it's expensive to miss them. So let's understand what we're talking about. A required minimum distribution starts at the age of 70 and a half for IRAs, and for 401ks and 403bs for individuals who are not still actively working and participating past the age of 70 and a half.
So the IRS says we've got to get our money eventually.
Yep, this is all that tax deferral has been nice, but now you're going to be required to take those distributions. And those distributions have to be taken by December 31st, or you'll be facing a 50% penalty. That's a lot worse than any tax rate that you'd be paying.
Yeah, in real dollars. I mean, if your missed distribution was $50,000, you've got to write a check to the IRS for $25,000.
That's right. So we make sure we spend a good 3 solid months making sure that every IRA account's going to pay out its distribution. this year.
More spreadsheets than you could possibly imagine.
That's right. We have one caveat to this just to make sure for all those ones out there. If you are the first year you turn 70 and a half, you actually have the ability to delay to the following year to April 1st, but that is the only exception.
Yeah. All right. Last but certainly not least for us, the seventh habit of highly effective investors at the end of the year is to take a look at your charitable giving, and are there any opportunities to improve the tax efficiency? And this is especially important in light of the new Tax Cuts and Jobs Act, so the new tax law that is effective during the 2018 tax year and onward. So
that's right.
How does that play out?
Yeah, this is something this is a new game when it comes to trying to hit your tax deduction and your charitable giving. And there are a number of strategies that you can employ. But remember, charitable giving is to actually support a cause or an organization that you feel strongly about. Secondly, most people would associate charitable giving with tax savings. So historically, a larger portion of the population would itemize. That meant that you would use your various deductions to reduce your tax liability. Yeah.
Yeah, so for example, if you're itemizing and you gave $100 to a charity, you might get $20 or $30 back in the form of tax savings.
That's
so
right.
You're saying that's not the case anymore.
Well, it is for some, but the population is significantly smaller. There's going to be 2/3 less people that are paying taxes. They're going to be able to itemize now. That means they're going to be relying on the standard deduction. So if I'm not itemizing and I give $1 to charity, I'm not going to necessarily see that 20-cent or 30-cent savings due to taxes. So there's a couple strategies that people are using. One is pooling, which is, well, I give annually to charity, and maybe that adds up to $5,000, and I want to group those together so I can get to a point where I am able to itemize. So now I'm going to give 10 or 15. I know those are big numbers, and I'm not to scare anybody away, but these are the types of numbers we're going to have to talk about to be able to get that deduction. So that would be a pooling strategy. The other one is, if going back to our last number 6, RMDs, is you can actually give your required minimum distribution directly to a charity. And that would make it a non-reportable gift. So removing that income from your tax return altogether. That is a very effective strategy. And we were spending a tremendous amount of time with our clients on that.
Yeah, so it doesn't matter if you itemize or if you take the standard deduction. If you're 70 and a half and able to give away that, it's qualified charitable distribution is what they're called, QCDs.
That's right.
You still get the same tax
Yeah,
savings.
that strategy is actually more effective than even if you were still itemizing. I would push you to really seriously consider that QCD. That is removing the income from your tax return. That might reduce your income for Medicare and other calculations that you're considering as well.
Yeah, and I'll circle back just for a second to the pooling. So if you're giving 15 every third year instead of 5 every year, some people, when we'll introduce the concept to them, they say, well, I don't want to give $15,000 away this year. Well, so there are a couple of different vehicles, one specifically called the Charitable Gift Fund, and a lot of the major institutions have these. And what you're able to do is you're able to give that $15,000 of either tax or appreciated securities, which is even better, so you can eliminate the capital gain. Yeah. So you give either the appreciated securities or cash to the Charitable Gift Fund, and you can essentially write checks to charities over the next 3, 5, 10 years
and they'll
from
track
that
it for you.
balance. They'll track it, but you get credit from a tax standpoint in the year that you actually put the money into the Charitable Gift Fund. So that's one that, with the new tax code, has come into a lot more use than it had before.
There's a lot of great planning about that. You can involve your family. Charitable giving is a great place to plan from.
Yeah, regarding involving your family, I mean, some of them have the ability, I think this is what you're referring to, you have the ability to give the gift of giving, and for your, for Christmas or Hanukkah, you can give a $1,000 gift to your grandchild and say you have to give this $1,000 away over the next year.
That's right.
To try and get those habits of charitable giving kind of instilled in your next generation. Or maybe I'll give you that gift of giving this year, Rick. I don't know.
I'll take it. I got a lot of groups that I'd like to support.
Perfect. All right, so that's 7. So I'm just going to go back through and restate them quickly, but number 1, consider rebalancing. You may or may not decide you want to rebalance, but at least consider it. Take a look. Know your distribution calendar, and this is mainly fund distributions. Tax loss harvesting. So are there any opportunities to harvest some of those losses to offset your gains? Number 4 is to perhaps opt out of automatic reinvestment to give you additional options for planning. Number 5 is maximize the opportunities for tax-deferred growth. These are your 401ks, your IRAs, your Roths, your HSAs. And number 6 is don't forget your RMDs. And last but not least, which I think is obviously our favorite, is charitable giving. That's number 7. So you'll notice a lot of this is tax related. The end of the year might be a great time to engage with your CPA and advisor team and make sure you're taking advantage of all the opportunities. As we always say, what a better gift for the holidays than tax efficiency. So on that note, this has been Victor Colella and Rick Winters from Advisor Investments, and we're thanking you for listening to another episode of the Advisor You Can Talk To podcast. If you've enjoyed this conversation, please subscribe, review our show. Specifically, check out the links that we talked about in the bio. You can also check us out at advisorinvestments.com/podcast. Your feedback is always welcome. We love suggestions. So if you have any questions or topics you'd like to explore, please email us at info@advisorinvestments.com. Thanks for listening.